Have you ever wished you could just test drive your investment ideas without putting any real money on the line? I mean, what if you could explore thousands of possible futures for a stock right from your own desk? Well, today we're going to build that exact machine, and we're going to use a tool you probably already have, Microsoft Excel. You know, this is the big question for pretty much every investor, right? You've got a great idea, a new strategy, but how do you know if it'll actually work without risking your hard-earned cash? What you really need is a kind of virtual playground, a safe space to see how your strategy might hold up against the wild, unpredictable nature of the market. And that's exactly what we're building today. Think of it as our very own what-if machine for investing. It's a really powerful financial modeling technique called a Monte Carlo simulation, and it lets you see the whole range of potential outcomes for a stock before you even think about clicking buy. Now, that might sound super complex, but the idea behind it is actually pretty simple. Imagine you're rolling the dice for a stock price over and over and over again, like thousands of times. A Monte Carlo simulation basically does that, but it uses a stock's past data to make sure the dice rolls are realistic. It helps us map out what's likely, what's less likely, and even those crazy, out-of-the-blue outcomes. So to get this machine up and running, we don't need a crystal ball or anything like that. All we need to do is look at the stock's history. We're going to pull out two really crucial pieces of information that are going to be the engine for our entire simulation. Believe it or not, you can boil down a stock's complicated movement into two main ideas. First, you have the trend. That's the Greek letter mu. This is basically the stock's average daily direction. Is it generally drifting up, down, or just sideways? And then you have the randomness, sigma, which is just its volatility. Think of this as the daily noise, that unpredictable jiggle around the main trend. Okay, so how do we use these two ingredients to figure out tomorrow's price? Well, the blueprint is surprisingly simple. We just take today's price, give it a little nudge based on its average trend, and then we add a realistic random jiggle. That's it. Seriously, almost every complex financial model for this boils down to that one simple, intuitive idea. So the logic here is just 3 easy steps. First, we need a starting point, right? So we grab the stock's most recent price. Next, we give it a little push in the direction it usually moves. That's our trend. But we all know the market isn't that smooth. So for the final and most important step, we add a dose of reality, a random jiggle based on how jumpy that stock has been in the past. You just repeat that process and you've mapped out one of thousands of possible futures. And here's that exact same logic, just written out in the language of math. Now, don't let all the symbols intimidate you. You already know the key players here. SFT is just yesterday's price. That little mu symbol, that's our trend. And sigma, that's our volatility. All the other stuff is just there to make sure we scale everything correctly for a single day. At its heart, this formula is just a precise way of saying what we already know. Tomorrow's price is yesterday's price, plus a little bit of trend and a random volatility-based jiggle. Okay, theory's great, but let's dive in and see how this actually works. We're going to take that formula and translate it into a language Excel can understand, using just a few simple built-in functions. First things first, we need to calculate our 2 key ingredients. Finding the trend is the easy part. It's just the average of the stock's daily price changes. We can do that with a simple equals average function in Excel. For volatility, it's a quick 2-step. We measure the stock's variance, or how scattered its returns are, and then use the square root function equals SQRT to turn that into a number we can actually use. Just think of it as the typical size of that daily jiggle. Now for the secret sauce. This little function right here, equals NORMSINV rand, is the engine that creates our random jiggle. See, random just spits out a random number, but NORMSINV makes sure that randomness is realistic. It spreads the jiggles out on a bell curve, which means small daily moves happen all the time, and those huge wild swings are rare, just like in the real world. This is what makes our simulation so powerful. And here it is. This is what it all looks like put together in one Excel cell. You can see it follows our blueprint perfectly. We start with L2, that's yesterday's price. Then we multiply it by 1 plus our trend, which is stored in cell F19. And then we add our volatility from cell H22, multiplied by our random jiggle generator at the very end. That number 29 in there, that's just the number of days in our simulation, helping scale everything correctly. This one line is our entire prediction engine. All right, let's get to the payoff.
We've built the machine, we've put in the ingredients, and now we run it. But what does it all mean? How do we turn a column of numbers into a genuinely powerful investment insight? So once you pop that formula in and drag it down for, let's say, 29 days, you get this. One complete simulated path that the stock price could take. It starts from the last known price, and then day by day, it carves out a brand new potential future based on the trend and volatility we calculated. And here is where the real power of this whole thing comes alive. Because our formula uses that RAND function, every single time you hit the F9 key in Excel, the entire path instantly recalculates. Poof! You get a brand new, completely different, but equally plausible future for the stock. Press it again, you get another future, and again, another one. It's incredible. And that's really the most important thing to remember here. The goal of this machine isn't to create one perfect prediction of the future. That's impossible, right? The goal is to quickly and easily explore thousands of possible futures, so you can see the whole spectrum of what could actually happen. So why does all this matter? Well, because now you can actually stress test your strategy against 1,000 different market scenarios. You can see how often it wins, and more importantly, how badly it might lose. You can get a real sense of the risk by seeing the best case, the worst case, and the most likely outcomes, which gives you a much deeper, more intuitive feel for your investment. Building this machine doesn't give you all the answers. What it does is give you the power to ask much, much better questions. It really changes you from being a passive investor who's just hoping for the best into an active strategist who's prepared for a whole range of possibilities. So the only question left is, now that you can see what might be coming, what will you prepare for?